Hello and welcome to Stock Voyage. So recently the stock market dropped by quite a bit, and I'm really concerned for new investors, as most investors haven't seen the real pain. It's easy to say just buy the dip, but when you have serious red days one after another, and you have to watch your profits evaporate in a matter of weeks, panic starts to set in. That is why I made this video, to calm you down. The stock market is not going to go to zero, and to make you feel a little bit calmer, I will also give you an estimation on how much the market will drop, when will it stop dropping, and what is the best thing you can do now. You're going to know the answers to all these questions by the end of this video. But first, subscribe and smash the like button down below so more people can see this and don't panic sell. Okay, so firstly, why is the stock market poised to have the worst start of the year since 2008? Well, inflation is at a 40-year high, and that happened due to record low interest rates combined with easy money, combined with chain bottlenecks, combined with shortage of labor and excess demand. In 2022, we'll also see slower growth because people already made their main purchases and subscribed to services. A good example would be Netflix, which reported extremely lower number of new subscribers than expected, and that naturally made the stock drop by more than 20%. We also have higher costs, and once again Netflix is a good example of that, as they have just increased their prices almost across the board. So naturally Federal Reserve wants to prevent the inflation from getting any higher, which means they'll have to start tapering. Tapering is how the Fed throttles back economic stimulus by slowing the pace of its assets purchases. It's basically a controlled way to phase out of quantitative easing while managing the continued economic recovery. In 2020, the Fed started with the process known as quantitative easing for the fourth time. In this process, the Fed buys massive quantities of government bonds and mortgage-backed securities to increase the money supply, encourage lending and lower interest rates in order to stimulate a lagging economy. Once the goals of that stimulus are met, the Fed may gradually begin to unwind the purchases and raise interest rates to allow the economy to restabilize. This process is known as tapering, and we can expect the first rate increase sometime around March. Now you would think that this would plunge the stock market even lower, but historically the stock market rather ends up doing quite well after a rate increase, with a median gain of about 5% in 6 months following the rate increase. Another good thing in this market is that it always comes back up. We can check out all these major drops in the past 20 years, which are extremely worse than this measly 10% drop at most, like the dot-com bubble, the 2008 crisis, the 2018 drop, and lastly the 2020 drop. Now if you could go back in time knowing what you know now, would you buy in the 2020 drop? Would you buy in the 2018 drop? Would you buy in the 2008 drop? Well, if you like making money, the answer is obviously no. Just kidding, yes, of course you would buy. After all, there is a reason why riches are made in recessions. So instead of looking at this drop negatively, you should look at it as a great opportunity to get in at lower prices. Now I don't know when exactly the stock market is going to stop falling, but I'm going to give you an approximate guess in order to make you feel a bit calmer. Now if we use the technical analysis, or in other words, like Benjamin likes to say.
Okay, no, technical analysis, it's art for the stock market. But don't get it confused. You are not Pablo Picasso. You're Van No, money, a madman and a failure doing astrology that determines whether you eat this money.
In my opinion, technical analysis works if enough people believe in it. It works like a self-fulfilling prophecy. For example, if enough people think that a certain stock is going to bounce off of a support, they will buy in, which, you guessed it, will make the stock price go up. Now here I have a daily chart of the Nasdaq index, with a red 180-day simple moving average line. As you can see, we have bounced off of this pretty consistently. In fact, since 2018 we have dropped below this line only twice, at the end of 2018 and at the beginning of 2020, and right now. Okay, so this support won't work. If we change the resolution to a weekly chart, we can see that the next possible support is the weekly 180 weeks SMA line. At the end of 2018 and at the beginning of 2020, the market bounced off of this line. So in my opinion, this line is a strong support. But remember, this only works if enough people believe it works and they buy in. I honestly don't see it dropping lower than that. So in this case, the market could drop by roughly 23%, which is quite a lot. So it could take anywhere between 1 month and 2 months of red days until we reach the bottom, depending on how steeply the market drops, based on this so-called astrology. But based on information I found on Investopedia, which is a great site by the way, a correction is a decline of 10% or more, and corrections tend to last between 3 and 4 months. So the best thing you can do now is to get out of margin. If you own stocks or indices, just hold and don't panic sell. If you want to use this as a great opportunity and invest more, but you have limited capital, I suggest you cut back on spending and calculate how much money you have available to invest in the coming months. Because you can't time the market, the best thing you can do is invest a fraction of that money each week. But if you want even better results, every week the stock market drops, you invest double the money you invested the week before. So the lower the market drops, the more money you invest. You can calculate how much money you would have to invest the first week with this formula. So the C stands for capital and represents how much money you want to invest. The W stands for weeks and represents how many times you want to invest, or in other words, for how long the stock market continues falling. And the X represents the amount of money you would have to invest the first week. So just a quick demonstration. Let's say you want to invest $10,000 over a span of 8 weeks. So you would need to divide $10,000 by 2 to the 8th, or in other words, you would need to divide by 256. So the first week you would have to invest $39, and each following week you would double down. Just to be safe, you should exaggerate with the amount of weeks you think the stock market is going to continue falling. So if the stock market drops slower than you expected, you still have money left to invest, and only invest in the companies that you strongly believe will survive this drop. And remember, I am not a financial advisor, so I encourage you to do your own due diligence or reach out to a professional financial advisor. If you suffered huge losses in the past weeks, check out the video that just popped up. Trust me, it will make you feel better about your losses. If you enjoyed this video, it would mean a ton to me if you liked and subscribed, and thanks for watching.